Hello, everyone. Thanks for joining me. I hope you can hear me. If you can't hear me, please use the chat feature to let me know. My alarm just went off, which means it's 12 noon. My name is Denise Appleby. Thanks for joining me for IRS Form 5498 and other updates. It's June 2024. Summer's here. We're about at the half mark for the year. Can you believe that? As we go along, what I'm going to encourage you to do is use the chat feature to ask your questions. And you know me, if you've been to any one of my sessions, your questions are not limited to what we're talking about today. So if you got a question from a client earlier this week and you didn't know the answer, this is your opportunity. It's just a little bit about me, a little bit about my products and services. If you ever think that you want to engage in my consulting services, please go to my website, deniseappleby.com, to sign up. So the topics that we're going to be talking about here today is the recent extension of the waiver of the RMD excise tax. Who's covered? Who's not? Right now, in my email inbox, I have an email from an advisor asking me if a client who is an eligible designated beneficiary qualifies for the waiver. I'm going to answer that question for you today. I'm going to be talking about IRS Form 5498. We know it was just sent out on May 31st. How can we use Form 5498 to help clients? It's just June, and we know we have until the end of the year to do QCDs and RMDs for this year. But I think you will agree with me that it's never too early to start having that conversation about RMDs and QCDs. Why wait until the last minute, right? So let's look at the first learning objective. IRS Form 5498. How do we use it to help clients? Now, you've seen it. This is what it looks like. It has a ton of boxes, but I'm going to be focusing on just a few of those boxes, right? The ones that I think are more impactful for your clients' 2023 transactions. But let's start with what's new for 2023 when it comes to IRS Form 5498. You remember the 529 plan to Roth rollover provision under Secure Act 2.0. This is effective 2024. But we got a nice surprise from the IRS instructions for 1099-R and 5498 when they explained that a 529 to Roth contribution or rollover, it's so confusing, that term, right? Rollover or contribution, because when Secure Act 2.0 came out, it referred to it as a rollover done as a direct trustee to trustee transfer. But when we looked at the instructions for Form 5498, guess where they're supposed to put it? In the Roth IRA contribution box. So it is a Roth IRA contribution, whatever you want to call it, that's the end result. Part of what came out in the instructions for Form 1099-R and 5498 is that this could actually be done for 2023 as long as it was done by April 15, 2024 and properly designated as a 2023 contribution. So if your clients did that, don't be alarmed. That was perfectly fine. What is reported on Form 5498? Regular IRA contributions, rollovers, Roth conversions, SEP and simple contributions, and recharacterizations of IRA contributions. And you know those revoked contributions where your client makes a contribution to their IRA and then they say, oh, psych, I don't want this anymore. I'm revoking that contribution because I have a right to, as long as it's done by the deadline. Those are still reported on the Form 5498. Here's a common question I get. Denise, why so late? 1099-Rs are issued by January 31st. Why is the Form 5498 issued so late? Well, the good news is that it's not required to be attached to the tax return of the IRA owner. Unlike a 1099-R, where if they have taxes withheld, those are attached to the tax return, Form 5498s are not. And also remember that anything that's reported on the 1099-R are only transactions that were completed by December 31st. So by then, they have all the data needed to include on the 1099-R. Compare that with a Form 5498, where we're still accepting contributions, regular contributions to traditional Roth IRAs in 2024 up to April 15 for the previous year. And some of those do come in after April 15 because the postmark deadline is midnight, April 15. So if someone drops it in the mailbox on April 15, midnight, we could get it, the custodian could get it 2 weeks later. So that's one of the reasons why it is so late. But it does create an opportunity for the advisor to say, you got a 5498, come into my office. Let's review your Form 5498. Make sure everything is copacetic. And if it's not, let's talk about how we can make fixes so you don't have an issue with the IRS. And so part of what I recommend is to do an audit of the IRA based on the information that's reported on IRS Form 5498. So I included some key questions that you're going to help work with your client to get the answer to. Was the contribution limit exceeded for 2023? We know that the maximum amount of contribution is the lesser of 100% of compensation, like salary, wages, tips, self-employment income. 100% of eligible compensation or 6,500, whichever is less. And for those who are at least age 50 by the end of the year, they can make catch-up contributions of up to $1,000. How do we know if the contribution limit was increased? Because right now, you're probably looking at the Form 5498 for the IRA that you manage, right? But here's what some customers do, and sometimes they won't tell you because they think you're going to get jealous because they're using another advisor for their other IRA. But let them know you just want to make sure everything's right. And to do that, you want to see all the Form 5498s for all the traditional Roth IRAs that they owned as at the end of 2023. And including those where contributions were made in 2024 for 2023. And guess what? Ask for a copy of the one for their SEP IRAs too. Why is that? Because you can actually make your regular traditional IRA contribution to a SEP IRA. And so we want to total all the amounts in box 1 and box 10 for all the Forms 5498 to see if the total exceeds the individual's maximum IRA contribution for the year. And if it does, then Houston, we have an excess contribution and we need to fix it by the individual's 2023 tax filing due date plus extension as a return of excess so as to avoid the 6% excise tax. Here's another audit tip. Were carryback contributions applied to the right year? Here's why this is important. You can make a contribution for the previous year from January 1st to April 15 of the current year, right? So they could have made an IRA contribution for 2023 up to April 15 of this year. The rule is when you send in that contribution to the IRA custodian, you have to designate it as a previous year contribution. Another term for that is a carryback contribution. And if you don't, then the custodian is going to report it for 2024. Now, the custodian is within their right to do that, and they're within their right to not fix it unless they made a mistake. But if the IRA owner told their tax advisor or tax preparer that it is a 2023 contribution, if it's a traditional IRA, they might have claimed the deduction for it, or if not, they might have filed Form 8606 for it to report it as a non-deductible contribution. But if it's actually being reported to the IRS as a 2024 contribution, then an amendment has to be made to the tax reporting that was done designating it for 2023. Here's another issue that I see happening a lot. Someone makes a contribution for the previous year. It was reported by the custodian for the current year. So come later, they want to make a contribution for the current year. The custodian says, pump the brakes. You already made a contribution for this year. Any additional contribution, the amount that you want to make is going to result in an excess contribution. And unfortunately, that is when some taxpayers find out that a mistake was made. So we don't want that to happen to the taxpayers that we're dealing with, which is one of the reasons why we're going to use the information in Form 5498 to audit that transaction. Is the rollover contributions correct? Is the rollover contribution box correct? That's box 2. What should be included in box 2? Someone takes a distribution from a traditional IRA, rolls it to a traditional IRA, a distribution from a Roth IRA, rolled over to a Roth IRA, a distribution from an employer plan that's rolled over to a traditional or Roth IRA, and that includes direct rollovers and indirect rollovers. Easy peasy, right? Well, so we think. Here are some of the common errors that occur. Someone does a trustee-to-trustee transfer between 2 IRAs. That's non-reportable. All of a sudden, we see it on the Form 5498. I know, that's crazy, but it does happen. Someone does a rollover that should be reported on Form 5498, but somehow during the data entry process, it was treated as a transfer. Now, you don't want that kind of problem. As the kids say, we don't want that smoke, because what we're going to have is a 1099-R for the distribution, no offsetting 5498. And so the IRS is going to come knocking to say, hey, IRA owner, I have a 1099-R for you. I don't see where it was rolled over. I don't see any Form 5498. So where's my money? And of course, we know that they don't owe the IRS as long as the rollover is a valid rollover. So if you come across a transaction where the client did a rollover, but it was not reported as a rollover by the custodian, now is the time to contact the IRA custodian and work with them to fix it. Box 3, this is where we report conversions from traditional SEP and simple IRAs that have met the 2-year period to a Roth IRA. That seems easy enough. And usually there's no mistake when this is done as a direct conversion. So you go to the custodian, you say, custodian, you have my traditional IRA, convert X amount directly to my Roth IRA. In my experience, mistakes don't happen that way. But that's a direct conversion. You can also do a conversion as an indirect conversion where you take a distribution from the traditional SEP or simple and you roll it to the Roth IRA within 60 days of receipt. That rollover is a conversion and should be reported in box 3. And I'm here to tell you that I've had fights with some of what you would consider the best custodian in the country, and they refuse to report these as Roth conversions. Now, that could be a red flag for the IRS, right? Because Roth conversions, if you're under age 59 and a half, are not subject to the 10% penalty. Neither are rollovers. But if you're reporting too many rollovers, the IRS might start looking at that, because you and I know that we can do only one IRA to IRA rollover during a 12-month period. So whether direct or indirect, the conversion must be reported in box 3. Here's another error. When you move money from a traditional 401k or other employer plan to a Roth IRA, that technically results in a conversion, but it's not reported as a conversion. It's reported as a rollover. So those are 2 of the common errors that you need to check for when you review your client's Form 5498. Box 7, it seems simple enough, but it's such an important box. Why? Because this box tells you what kind of IRA you have. Do you have a traditional SEP simple or Roth IRA? I'll tell you a true story where an individual rolled over a significant sum to what they thought was a traditional IRA, right? Turns out that the IRA that had been opened was a Roth IRA. What do we have here? We have a Roth conversion, which means the amount's going to be included in income. That's not what they wanted. This person wasn't planning to pay income taxes on that amount until they started taking required minimum distributions. But now here we have an unintended Roth conversion, where if the custodian doesn't fix it, then it's going to be included in income. One of my conferences that I spoke at in May, one of the advisors told me that she had an error that was like that, but reversed, where someone took a distribution from a Roth 401k and it was rolled over to a traditional IRA. You and I know that such a rollover is not permitted. No, I'm thinking that that should be an easy fix with the custodian, but I don't know what's going on, but they refuse to fix it. If you detect that early, as soon as the Form 5498 is issued, it is more likely that the custodian will fix it. But if you wait too late, let it bake too long in the IRA, some of them are resistant, right? You definitely want to have mistakes fixed before the 3-year period within which they are allowed to make corrections. So that's it for Form 5498. If you have questions about Form 5498, please post them in the chat. Hey, do you have questions about 1099Rs? Please post them in the chat. I'm happy to answer those as well. Let's move on to the waiver of the excise tax for RMDs, one of the most popular topic right now for IRAs. So let's talk about why we're here. The Secure Act was signed into law in 2019, effective 2020. And part of what was included in the Secure Act was the repeal of the full life expectancy distributions for designated beneficiaries, which are individuals and see-through trust. On the Secure Act, it says, unless you are an eligible designated beneficiary, which means unless you're the surviving spouse of the IRA owner, beneficiary not more than 10 years younger, a minor child of the IRA owner, a beneficiary who's disabled or chronically ill at the time of the IRA owner's death. Unless you're one of those, you are not an eligible designated beneficiary. You are just a plain old designated beneficiary, and you have a maximum period of 10 years within which to distribute any IRA or employer plan that you inherit. Now, here's the thing. When the language in Secure Act 1.0 says, remember the old 5-year rule? It still applies to non-designated beneficiaries, but remember the 5-year rule? Under the 5-year rule, distributions are optional for year 1 through 4. You got to empty the account in year 5. Well, the 10-year rule is like that, except that it's 10 years. That seems black and white to me, and almost everyone in the industry agreed that that's how it works. But then when the proposed RMD regulations were issued, the IRS says, you guys are forgetting that the at least as rapidly rule applies to beneficiaries. All beneficiaries that inherits an IRA or employer plan from someone who was already taking required minimum distributions when they died. So in any case where someone died on or after the required beginning date and the beneficiary is a plain designated beneficiary, it is true that the 10-year rule applies. But what is also true is that they must take annual RMDs over their single life expectancy, beginning by the year following the year in which the account owner died. And so people got up in arms saying, you tricked us because now you're telling us that we're subject to annual RMDs, which means that because we didn't take it, because you led us to believe that we didn't have to, now we owe you 50% excise tax on the RMDs that we didn't take. And the IRS says, you know what? You're right. The language was confusing. And to help you out, here's what we're going to do. We're going to waive the excise tax on any RMDs that you should have taken, but you didn't. We're going to waive the excise tax for 21 and 22. They extended it to 23, and now they've extended it to 2024. So one of the things that you want to remember here is that it applies only to 10-year beneficiaries. Who are these beneficiaries? They are plain designated beneficiaries who inherit an IRA or an employer plan after 2019, and the account owner or participant died on or after the required beginning date. We know this does not apply to Roth IRAs because there's no such thing as required beginning date for Roth IRAs, because Roth IRA owners are not subject to RMDs, right? So here we have the 10-year rule plus annual RMD requirement only applies to designated beneficiary when the account owner died on or after the required beginning date and died after 2019. There's a second class of beneficiary that it applies to, and that's a successor beneficiary, where the primary beneficiary was taking distributions over the primary beneficiary's life expectancy, or if the account owner died on or after the required beginning date, the longer of the primary beneficiary's life expectancy or the life expectancy of the decedent. When I talk about life expectancy for beneficiaries, it's always single life expectancy, right? Because that's the only life expectancy table that can be used for beneficiary accounts. Now, in this case, where the primary beneficiary was taking life expectancy distributions over their full life expectancy, when that primary beneficiary dies after 2019, then the successor beneficiary must continue taking annual RMDs using the life expectancy that the primary beneficiary was using, but they continue those distributions for no more than 10 years after the year in which the primary beneficiary dies. So you see the theme here, right? Annual RMDs for no more than 10 years. Those are the only two classes of beneficiary which qualify for this automatic waiver. Some of the questions that I get about this is, so someone who inherited an IRA in 2020 took advantage of the waiver up to 24. Do they have to play catch up in 25 when they start? No, they don't have to. That's optional for them. But bear in mind that the 10-year period is not extended. So that beneficiary would now only have 6 years over which to distribute the inherited account. And so that becomes a tax question, right? Do you want to take advantage of the waiver and not take RMDs? Or do you want to spread it out over 10 years to mitigate the tax impact? And the answer is going to be different based on the client's tax profile. Because for some, it makes sense to take advantage of the waiver. You know, maybe you're making $1 million this year. Next year, you're not going to be making anything. Then it might make sense for you to wait until next year to start taking RMDs. The idea is that you got to profile a client to make a right recommendation, right? Now, it's important that we know that it's the excise tax that is waived, not RMDs. Why is that important? Because if you remember in 2020, when RMDs were waived under the CARES Act, those who were subject to the 5-year rule got an additional year, so they got 6 years. If RMDs were waived here, then the 10-year period would have been extended for each year that the RMD was waived. RMDs weren't waived, only the excise tax. Another thing to think about is if this is an employer plan like a 401k and your client wants to roll it over to an IRA, which they can if they were designated beneficiary, then RMD amounts cannot be included in the rollover. The IRS made that distinction when they waived RMDs in 2020 to say that, yeah, this can be rolled over because RMDs were waived. RMDs are not waived here, and those are the two ways that this impacts. So when you have conversations with clients about this waiver, be sure to explain to them that is the excise tax that is waived and not the RMDs. Now, because this is an automatic waiver, there's no need to file Form 5329 to request a waiver of the excise tax. It's automatic. And if your client already paid the excise tax because they didn't talk to you first, then they can ask for a refund and the IRS will refund that amount. Let's talk about QCDs and RMDs. But before I do that, I see we have two questions here. Would every IRA have a Form 5498? What an excellent question, Doug. And the answer is yes. For every IRA, a separate Form 5498 would be issued. Now, if the IRA custodian already issued the fair market value statement by January 31st, and there's no contribution activity to report, they don't have to issue a Form 5498. Some still do. But if your client did not receive a Form 5498, that could be why. But if you think that your client had reportable activity and they didn't receive a Form 5498, then we need to call the IRA custodian and find out why they didn't issue one. Maybe they treated a rollover as a transfer, for instance. Then we need to have that fixed. And if your client has a traditional IRA and a Roth IRA, separate Forms 5498 would be issued for that. Is the form issued only if there are contributions? Not necessarily. There are other transactions that Form 5498 is used to report. The fair market value statement. I see you asking if there is an example. Send me an email, please, and I'll send you information about the fair market value statement. It could be like a one-page document where the IRA custodian says, this is the fair market value of your IRA as of December 31st of the previous year. This information is being reported to the IRS, something like that. What is important about the fair market value statement? Of course, we want to know what is the fair market value of our IRA at all times, right? But if someone is at least age 73 this year, they would have a required minimum distribution. The fair market value, it would be used to calculate their RMDs for this year. Part of what you asked do is it used to report only contributions? No, sometimes it's used to report is this person subject to a required minimum distribution for the year? But again, any information that was already reported by January 31st, including the RMD notification, if there's no contribution activity, then there's no need to issue the Form 5498. SEP IRA contributions, simple IRA contributions, recharacterizations where your client might have said to you, you know what, I made a regular IRA contribution last year to my traditional IRA. I don't feel like that was the best move for me. I want it to be a Roth IRA contribution. They would have recharacterized that. And if it was done in 2023, it would be reported on the 2023 Form 5498. By the way, your client has until their tax filing due date plus extension to do a recharacterization. If they file their tax return by the due date, they get an automatic 6 months extension to do that. Great questions. Let me see. QCDs and RMDs. Here's why I decided to include this, because usually I get the call in like October and my client will say, Denise, my client wants to do a QCD from their IRA. They took their RMD this year. How do we fix that? Because their RMD is 50,000. They want to make a QCD of 50,000. What do we do now? Can we make the RMD go away? No, we can't make the RMD go away. Why? Because for any year that you have an RMD, the first distribution that you take goes towards satisfying your RMD, and RMDs cannot be rolled over, right? So in this example that I use, where the client wants to do a QCD of 50,000, already did an RMD for 50,000, what's the solution? They can still do a QCD, because even if your RMD is $1 million, you can still do a QCD of up to $104,000. That's the amount for this year. But if you want your QCD to also count as your RMD, which is pretty sweet if you don't need the funds, then make sure the QCD is the first thing that is done from the IRA, or make sure the QCD is done before the RMD is satisfied. So notice that qualification that I made, because I hear people saying, oh, your QCD has to be first, be your RMD. No, that's not true. Let's say someone wants to make a QCD of using my example, 50,000, right? Let's say their RMD is 100,000. Then if they took a distribution of 50,000 first, that goes towards their RMD, then the second distribution can be a QCD of 50,000, right? So it doesn't matter in which order it's done if the total between the QCD and the regular distribution does not exceed the RMD. But if you want your QCD to 100% goes towards your RMD, and the amount is the same, so your RMD is 50,000, you want to do a QCD for 50,000, you don't want to do any other distribution, then you got to do the QCD first. And you can do QCDs as long as you're at least age 70 and a half or older. If you're age 70 and a half tomorrow, you got to wait until tomorrow. QCDs can be made from traditional IRAs, Roth IRAs, SEP and simple IRAs that are not ongoing, meaning no contributions are made to the SEP or simple for the QCD year. And that includes inherited IRAs. I wrote an article recently about QCDs, and I said it could be done from Roth IRAs, and an advisor challenged me, like, what are you talking about? You can do a QCD from a Roth IRA? You can't. And here's why he was saying that, because the purpose of a QCD is to have the distribution excluded from income due to being a QCD. Can you do that with a Roth? It depends. If your client is already eligible to take a qualified distribution, then that amount cannot be used for a QCD, right? But what if your client's not eligible for a qualified distribution and they have earnings in the Roth IRA? Usually, if they take a regular distribution, it would come from their basis first, the earnings last. But for a QCD, the earnings first, and the earnings go to QCD. Any amount in excess of the earnings would be non-taxable and would not be considered a QCD. So, yeah, it can be done, but the QCD would be attributed to only amounts that would be taxable if they were regular distribution. Same thing for doing a QCD from a traditional IRA with basis. It's attributed to the taxable portion first. And if the check that the custodian sends to the charity exceeds the taxable amount, then the amount in excess of the taxable amount is not treated as a QCD on the tax return. Instead, the taxpayer can claim it as an itemized deduction. I wrote an article for this for Lineberg, Lineberg.com or Lissy. You'll see me include examples of that, including the Roth and the distributions that include basis. So Lineberg.com, I just wrote an article for them on that. I try to answer your questions in articles, because sometimes you just need more than me talking about it. You need to read it, right? We all have different ways in which we learn. Now, QCDs are reported as regular distributions under Form 1099-R. No special reporting, which means that it is the tax preparer's job to claim it as a non-taxable distribution due to being a QCD on the individual's 1040 or their tax return. And the instructions for line 4A and 4B, if you go to the instructions for 1040, tells the tax preparer exactly how to do that. But you know what? The tax preparer won't know unless the IRA owner tells them. The 1099-R that you got is for a QCD. Now, sometimes they don't tell the tax preparer, and it's not because they're hiding anything, it's because they don't know that they're supposed to provide that information. And so my recommendation to tax preparers are include those questions on that intake sheet that you send to your clients every year, and be very clear about the question that you're asking. Do you take a distribution and donate it to a charity? How old are you? Which charity is it? Because you want to determine if that distribution qualifies to be a QCD. They don't know what information to give you. And so your questionnaire is going to help to make sure that you get the information that you need. Denise, I may have missed this, but wondering if a Form 5498 is issued for an inherited IRA. Absolutely, it is. to report the fair market value. And also remember that for an inherited IRA, we could have rollover contributions from employer plans, right? That's the only time you can have a rollover contribution made to an inherited IRA, by the way, because if someone takes a distribution from an IRA, they cannot roll it over to an inherited IRA, which is why you want to tell your clients, don't touch your inherited IRA until you talk to me, because if you want to move it, I'm going to help you move it right. So yeah, you can get a 5498 for an inherited IRA if they have reportable transactions. I am enjoying these questions. I'm sure you have more. Please send them to me. I'm happy to answer them. Now is the time to get your question in. And if you're not my client, now is the time to get your questions in for free. Let's talk about some new Secure Act provisions that are effective this year. Penalty-free withdrawals for victims of domestic abuse. It's only $10,000. I, hope it could be more, but your clients can withdraw up to $10,000. If it's an employer plan, then the 50% of their vested account balance within 1 year of the incident without the 10% penalty. Now, remember that for some exceptions to the 10% penalty, custodians are not required to report those distributions as exceptions on the 1099-R. So if your client qualifies for an exception like this, and the 1099-R shows a code 1 in box 7, then the tax preparer must file form 5329 to claim the exception that your client qualifies for. IRA catch-up contributions finally is indexed for inflation effective this year. And no more required minimum distributions for designated Roth accounts like Roth 401ks. Never understood why they were subject to RMDs in the first place, but now they're finally on an equal playing field when it comes to RMDs with Roth IRAs. So now you don't have to tell your clients, hurry up and roll over your Roth 401k to your Roth IRA so you avoid taking RMDs. No need to do that anymore, because Roth 401ks, Roth 403bs, governmental Roth 457bs are no longer subject to RMDs for the owner, though. Inherited Roth IRAs, inherited designated Roth accounts are still subject to required minimum distributions. Bonus. So we have a few minutes. So what's the bonus? It's Form 5498 for SEP and simple IRAs. Every time Form 5498 is issued, I get a bunch of calls from tax preparers who are confused by the fact that a client may have made a SEP or simple IRA contribution for 2023, for instance, and it's not reported on the 2023 Form 5498. Why does that happen? Because an employer has until the tax filing due date of the business plus extension to make a contribution to a SEP IRA. So here's a potential scenario. Employer makes a SEP IRA contribution or simple IRA contribution for 2023, but they made it in 2024. And so when you get the 2023 Form 5498, it's not on there. Why is that? Because the IRS instruction is you report the SEP and simple contribution on the Form 5498 that is issued for the year in which it was actually received. So if the 2023 contribution was received in 2024, it's going to be reflected on the 2024 Form 5498. Because, let's assume that the contribution is being made on October 15, because they can do that if they're a sole proprietor, for instance, and they have a tax filing due date plus extension of that October 15. There's no way it could be included on Form 5498, right? Recognizing that that's how the IRS drafted the rules, and the IRS understands that the Form 5498 is likely not going to correspond with the employer's deduction for the year. And you could have a SEP, a 5498, showing SEP contributions of well over the $69,000 limit because contributions were made for 2 years in 1 year. So don't worry about that. If it becomes an issue, and I'm not aware of in any case where the IRS questions it, but if it becomes an issue, it's quite easy to prove. Some key takeaways, IRA and reminders, IRA custodians do not track basis. If your client makes a rollover of an after-tax amount to a traditional IRA or makes a non-deductible contribution to their traditional IRA, the responsibility to track that basis from those after-tax and non-deductible contributions so that they don't end up paying income taxes on those amounts, that responsibility is the IRA owner's. And the IRA owner can pass that on to the tax preparer. If they don't file Form 8606 to track the basis, they're going to end up paying income taxes on those amounts that should be tax-free. An IRA owner can receive multiple Forms 5498 from multiple IRAs and multiple types of IRAs. So those clients who like to have IRAs all over the place for whatever reason, they're going to have multiple Form 5498s. Form 5498, we don't have to attach it to the tax return, but it creates one of the best opportunities to audit your client's IRA transactions. Carpe diem, I say, use that as the opportunity to make sure that your client's transactions were processed correctly. And if not, then that's when we contact the IRA custodian to ask them to fix it, because they're still within that period where they can fix those Forms 5498. And all they need is proof that either they made the error or there's good reason to make the correction. And in some cases, it might be necessary for the tax preparer or tax professional to get on the phone with the IRA owner. That has been my experience in a lot of cases, because sometimes the IRA owner doesn't know how to explain what the issue is, and having a professional on the line with them helps them to have the message come across to the custodian more effectively. So that's it for me. Thank you for joining me for your Lunch and Learn. I'm gonna upload this recording to my YouTube channel so you can watch it as often as you need to. I want to thank you for your questions, even though I was expecting more questions, but I know how it is. Sometimes it's lunchtime and it's last minute, but we're now almost at the 45-minute mark. You have my email address. If you think of any questions afterward that relating to anything that I covered in this session, please send me an email. Just remind me that it's related to this particular session so I don't send you a bill. Okay? Enjoy the rest of your day, and thank you for joining me.